So today we're going to be talking about what is a mortgage foreclosure sale, how does it work, and most importantly, how can you make some money on it or get a really great deal on a property. So a mortgage foreclosure sale happens when someone doesn't pay their mortgage, they get lots of notice, and then the property is put up for a public auction because the person hasn't made good on their mortgage payments. Now, you as a bidder are able to go down to that auction and buy a property. You want to make sure that when you're looking at this, check to see if there's any requirement to pre-register. For most of them there aren't, but in some there are. So where you get the list for the foreclosure, which I'll talk about in a moment, make sure you look to see for their conditions of sale. And part of the conditions of sale will be, what do you have to do in order to be allowed to bid? Sometimes you have to put down a deposit. Sometimes you just have to register. Oftentimes you can't do that the same day of sale, so you need to make sure you check that out in advance. So what you're going to be doing at these sales is bidding on the property and hopefully winning one at a really great price. Often the prices at these sales are really good. 30–40% off is not uncommon to do. So if you think about average house in America that's $400,000 house, if you get 30% off that house, you're buying a $400,000 house for $280,000. So it's a pretty amazing deal, right? Now, why wouldn't everybody do this? Most people won't necessarily take the time to understand the process. And here's the biggest catch. You need cash. You can't buy with the mortgage for some legal problem reasons, and also because mortgage companies can't move that fast. But legal problems are that sometimes people fight the foreclosure and mortgage companies don't want to buy into that. So there's nothing illegal about buying a foreclosure or anything. Just mortgage companies don't want to get involved with fights like that. So you will need to raise money or have the money yourself to buy the property, which can be fine, but just understand it. You're not going to use traditional financing. The way that these sales work from your perspective as a bidder is, first thing you're going to do is get a list of properties that are being put up for sale. As easy as doing a Google search. Mortgage foreclosure, DeKalb County, Georgia. Mortgage foreclosure, Philadelphia, Pennsylvania. And make sure you look for the sites that are government websites. What you don't want to have is looking at lists from commercial service providers. Half the time they're not even accurate. They charge you for it. There's no reason to pay for it. You want to get the sale list directly from the source. If it's a mortgage foreclosure, it'll probably be the sheriff of the county. It's the most common person who will be selling it. If it's a deed of trust foreclosure, then it's a trustee that's going to be selling the property. Either way, it's kind of the same to you. Make sure you get the list from that source, because they update the list as properties are removed from the sale, so they won't be sold at that particular sale. They'll update it. Commercial service providers generally won't update their lists. So make sure you're getting the list direct from the source. Make sure you look at the conditions, know when deposits are due. Generally, there's a cash-only sales. You're going to pay by either cash or money order or certified check. Usually the money is due right away, so make sure that you're aware of that. It may be that you walk up to the front of the room and complete your purchase. It's like that in some places. Maybe they give you till the end of the day to do it. Make sure you ask a lot of questions. And when you're getting into this business, make sure that you go to a couple of auctions so that you can get a feel for how they work, how quickly they go, what the pricing is like, who the players are. That's a lot of fun anyway, and definitely go down to that. Now, this is very much a due diligence game. So when a property is advertised for sale at a mortgage foreclosure, you don't know if it's the first mortgage that's foreclosing or a home equity line of credit. And it's important that you know, because when a mortgage is recorded first, let's say a mortgage was recorded January 1st of 2010. If there's another mortgage that was recorded, say January 5th, 2010, the mortgage that's recorded earlier in time is called a first mortgage, and the mortgage that's recorded later is called a second mortgage, as you might guess. The difference is that if a first mortgage forecloses, it wipes the second mortgage off the property. If, however, the second mortgage forecloses, then the property comes under and subject to that mortgage. So make sure that you know what mortgage is foreclosing and if there are any other mortgages on the property. And make sure that you check that out either by doing some title work or getting a title search. Make sure that you know that, because you don't want to buy a property thinking, I got this great deal, and then you find out it came with a mortgage on it. And if you don't pay off the mortgage, they're going to foreclose on you. So make sure that you check that out. And no one takes care of you in this business. It's not like someone's going to say, oh, by the way, this is being sold under and subject to our first mortgage. They're not going to say that. They're just going to accept your bid and take your money. So make sure that whatever you do, you become knowledgeable and you check things out for yourself. And don't just believe that it's all going to be okay. Believe that Murphy's Law is very alive and well. And it's possible that if you don't check something out, it'll probably result in something bad. So you're going to go to the auction, register in advance. If you're the high bidder, you go and put your money down. What happens next is that you can then go over to the property. If it's vacant, you can change the locks and take over. If it's occupied, then your responsibility is to work with the owners to get them out, or work with whoever the tenant is to get them out. Hopefully you can avoid a legal process, meaning a legal eviction. So talk to them. Cash for keys is usually a good idea. $2,500, $3,000, get them out of there is well worthwhile. Because if you have to go through the court process, you're probably talking about a couple of months and thousands of dollars in costs and fees to do it. So don't be penny wise and pound foolish. If there's someone in there, talk to them and see if there's something to work out. For anything you bid on, make sure that you understand the title. Make sure you understand if there are IRS liens. Here's a little trick with the IRS lien that you need to know. So with IRS liens, they last for 10 years from the time they're recorded. So if you see an IRS lien that was recorded, 9 years ago, I wouldn't do anything about it. I would just take the property, and when the 10-year anniversary of that lien being recorded comes around, then that lien is going to fall away from the property. You don't need to worry about it. But if it's a lien that was just recorded in the past year or two, know that that's going to be sitting around until it reaches 10 years, and either you have to pay it off or you have to wait it out. And while you're waiting it out, then you can't refinance the property and you can't sell the property because you still have that lien on it. So just keep that in mind. Most properties don't have those liens, but some do. So make sure that, again, you're doing your due diligence on the properties. Let's talk about the process of assessing the property. For every property that you buy, you do need to drive by the property and check it out. So when you get your list, which you can get anywhere from 30 to 45 days in advance of the sale, check off the ones that are in areas you're interested in, and then do your first level of due diligence, which is just look them up on Google Maps. Take a look at the street, take a look at the house as it shows on Google Maps, and see if it's interesting to you. If it's interesting to you, then move forward. If it's not interesting, skip it. What you want to do is eliminate all the properties that you can from that initial list, and then about 4 days before the sale, pull the list again, see what's still left on it, and match that up against your list of properties that you liked, and that's going to give you a short list of properties to go drive by. Then go out there and drive by the properties. Knock on the doors. See if anybody's home. Find out what their story is. Make sure that you assess the condition so that you're not getting any surprises or unhappy surprises. And actually get out of your car, walk up to the front door, be bold, and knock on that door. Find out if someone's there. Are they a tenant? Are they a former owner? What are their thoughts? What are they going to do? Make sure that you do all that, because I don't want you buying a property and then finding out that it's got problems that you didn't know about. They don't offer open houses. They don't give you any help with that. So make sure that you are entrepreneurial enough to do that on your own. You really do need to be responsible for yourself. On the other side of this, though, there's some amazing deals. 20 and 30% off is pretty common to do. So it's worth the effort, or as my friend Tom would say, the juice is worth the squeeze, but it is a squeeze. It's not nothing. And just make sure you thoroughly check everything out, because the thing you don't check out is probably the thing that will go wrong. So make sure you do check it out. And when you get these properties, these are ones you can often get cheaply enough to fix and flip. You can have them as great profitable rentals. Really terrific business opportunity for the person that takes the time to understand the business and the time to learn it. There's also a related business called Overages that you can see a video link down at the bottom of the description that talks about a way to make money on properties that you never bid on. You could do that with mortgage foreclosures, and you can also do it with tax foreclosures. Pretty interesting and a good thing to have in your back pocket. I've moved mostly to overages these days because I love overages. I get to help people get money that they thought was forever lost and they'd lost everything. Helps them get it restarted in life, so I think it's wonderful. And I think if you really tackle this business, you'll find it's wonderful too, especially if you do it the right way, where you're helping people. I'm going around getting them big lump sums of cash, and that's really useful to someone in foreclosure. That's nearly a miracle. So that's how you do mortgage foreclosures. If you want any more information, put your comments down below. If you want to know more about the overages business that I do, just click on the video link down below, which is the intro to the overages business. But most of all, get out and do something. Every great journey starts with the first step. So start your first step. If it's going to be mortgage foreclosures, go to your first auction and just check it out. Start learning everything you can learn and get ready, because soon enough you'll be out there with real cash and you could be very, very successful. Many of the successful real estate investors that I know are not bookish people. They're down-to-earth people. Down-to-earth people have figured out something great to do, and this can be your great thing to do. So this is Bob Diamond signing off for now. If you want to know more about overages, click on the overages video, and I'll be anxious to hear your opinions and what you think. Put those down in the comments, and I will see you next time.